navigating the increased regulatory and uncertain environment. I am extremely delighted to welcome the panelists for the session and request them to please come to the dais. Shri Ashwani Kumar Tiwari, MD, Risk Compliance and Sarge, State Bank of India. Shri R. Subramania Kumar, MD and CEO, RBL Bank. Madam S. Srimati, ED, Indian Overseas Bank. Shri Ashutosh Chaudhary, ED, Indian Bank. And our moderator for the session, Shri Abhinav Bansal, Managing Director and Partner, BCG. May I request Shri Abhinav Bansal to initiate the panel discussion? Over to you, sir.
Should we start, or there are people outside for the tea? We are okay to start?
Yeah, we can start.
Okay, thank you very much. A very good evening to everyone, and I hope we are refreshed with a quick tea break. Now, as the theme of the session or the entire FIBAC is winning in uncertain times, I think we cannot win in uncertain times till we have a good handle on risk and compliance. So this is by far the most important topic of the 2 days that we are going to be spending together. To get started, I'll pose the question to Mr. Tiwari. Sir, if we look at risk and compliance, there is one aspect around compliance with the regulations, right? But then there is an aspect around real balance sheet. You know, bank is a going concern. Right? When we look at something as uncertain as climate risk, there have been a bunch of regulations, that ask us to comply with certain things, and across geographies, not just in India. But when it comes to really managing balance sheet around climate risk, how do we start modeling some of these kinds of risks into our pricing, into our underwriting decisions? How do you navigate?
So thank you for having me here, and I'll just correct the designation. It changed as of today to corporate banking and subsidiaries. So just on that note, but since the invite came earlier, I think in that context I can answer this question. So you're right, compliance in its most basic sense is complying with the rules of the regulator, the bank's own policy, and government policies, if any. However, in case of climate risk, especially with regard to India, there are no regulatory guidelines as of now, largely, other than the reporting part under ESG for BRSR, SEBI's Business Responsibility and Sustainability Framework. So therefore, as we engaged with the regulator, and I believe in the morning there was some discussion or some questions on climate as well, IBI is engaged in climate risk scenario analysis, and they will be publishing it shortly. That's our understanding, and feedback was sought, and we have given that feedback as well on what the scenarios should look like. So that is one part, that scenario analysis in terms of how climate risk should look like, and then therefore the next question will therefore be to provide for it if the risk is higher. So in that context, for us as a bank, there are two things we are trying to do in climate risk modeling. One is that we have just came out with an RFP, and it's being revised and will be coming out again, is to measure the emissions of our portfolio, the scope 3 of the portfolio. And this would be done at a bank level under the standardized measurement protocols, plus also at sectoral levels, because ultimately all emissions will drill down to the individual company, and prior to that the sector. So this is one activity which we'll do. And the other thing which we have done as a bank is to map our entire portfolio of mortgage loans, the collaterals, the SMEs, even corporate collaterals, PIN code wise to the Indian Meteorological Organization's map of vulnerability in terms of physical risk. So we now know which of our collaterals and accounts and mortgages are exposed more to things like landslides or flooding, etc., etc. This part has been done. And as we speak, we are kind of refining and updating that. But the key question is that once we have done this, what next? And for that, we are looking at two solutions. One, of course, is the regular insurance solution, which We will now need to see specifically whether the concerned geography or the physical risk in that particular segment is covered specifically or not. Too often, insurance is very generic. We just call it comprehensive, but the exclusions may sometimes exclude the physical risk altogether. So we have to see that, and of course, followed by building code adherence, etc., which we'll see. Now, in terms of modeling, once we have the RBI scenarios, then we will start to look at the, first of all, the impact, both in terms of physical risk and where measurable the transition risk as well, because we do understand that if India has a net zero target of 2070 and a 50% renewable target by 2030, then if we today fund a coal plant for 25, 30 years, there is a risk of that plant becoming a standard asset down the line. So how do we model that risk of transition into our model? That's the other approach. And of course, once we recognize the physical risk and the possibilities of that happening, then what is the impact of that on the collateral and therefore to the value of the credit, and followed by the impact, if any, on the cash flows of the borrower, which in turn will convert to a credit loss modeling as well. So this is something we haven't done so far. And this is a work in progress, and we are trying to work with a lot of startups in this area, a lot of risk advisories, because these are very, very specialized activities and not done in India so far. And of course, we are looking at protocols like the NGFS, etc., to see that can there be some guiding factors and scenarios. So it's a long haul, but I think we have to start somewhere. And hopefully, this would be one way. One last point I would add, that we are trying to set up a risk management association, and all the banks have been taken on board, and everybody is agreed on that, and hopefully in the next 1 month and maybe a little more, we would have done this, and the first item on that list will be this, a climate risk, and how do we model, and maybe that approach can be then uniform across banks, rather than having each bank trying to do its own thing, because this is very costly, this is very complicated, and there is no previous record of how to do it. So I think that's the early response to your question in terms of modeling. There is a great deal more on that. Thank you.
Thank you, sir. Thank you for that detailed description of the methodology. Mr. Chaudhary, if I were to hear Mr. Tiwari, he talked a lot about data, how we are using data to derive some of the insights on climate risk, how that is being used analytically to model this risk. And, in the absence of historical data, how we are actually trying to create models which could predict what is going to happen in future. Now, how do you see digital and data at a more broad level? If I get outside the paradigm of climate risk, but more broadly in risk and compliance, how will it shape the future? And in that context, how will the role of CRO, the Chief Risk Officer, how will that change?
Yeah, thanks, Abhinav. Thanks, Abhinav. And deriving classical questions about data and how this data is used for a better risk management and how the role of CRO that will evolve or already evolved in this banking space. I will share my thought process in this. So, if we see the data, its use, the analytical way of use in the retail space is for quite some time, and it is by and large used by almost all financial players. So I will come with this use of data and how it can be fruitful for better risk management in a corporate banking space that I will try to give in this. So I will see the data analytics and the predictive modeling part simultaneously for the better risk management. Suppose I know a company's name and CIN. So in the digital arena, can I derive a lending process or a investment process from these two aspects, from these two information? I have CIN, I can collect directors' information, I can understand the cross-holding of directors in various companies, I can extract the balance sheet, I can do a analysis as per my format, I can understand the downstream industry, the upstream industry. When I say downstream, it means the debtors of that particular company. And when I say upstream industry, I understand the suppliers of that company, how they are doing. So all these things I can extract digitally. The informations are available and I can derive an accurate information. So it will be a better use for the decision maker. Uh, when we are contesting for CRO role, the for CRO, it will be a better decision making process with an accuracy of data. So while this predictive modeling I'm talking about, this predictive modeling will help also in the fraud detection part. When again I'm coming the fraud detection part in the retail space or the retail transaction space, it is almost quite matured, but in the corporate space, the financial fraud transactions with an accurate model, it can be detected real time. If not real time, I think so it's a near real time also this can be done. Now, with this data and the information that is available and stored, can I make the customer profiling which is more dynamic as the information flows? And when I say the information, it's not the static information I'm talking about. It's a dynamic information. Information comes in the news channel, media channel, XYZ. So can I make this process a dynamic risk profiling of my customer? Now, with this dynamic risk profiling of my customers, the second step, I understand, can I do it a better automated compliance function in the bank? When I'm saying compliance, the regulatory compliance nowadays are on an ongoing basis. It's not in a particular cut of time or date. So with this digital data, I can do this compliance in a better way in an ongoing basis. And while taking all these things in the clue, the digital data, the information, the foremost questions that comes to our mind is the cyber risk, obviously. So with this digital information, I will not say data, with this digital information, the cyber security architecture or posture of the organization can be made much more robust in this space. So while taking all these things into account, the CRO role has now evolved from a mere regulatory compliance to a more strategic role. Earlier, the CRO used to say, see, this is, the risk is like this, the profiling is like this, whether we can go, whether we cannot go. But with this change in this data and its availability and its predictive modeling, the CRO can say to the management, look, these are the companies which are available in the market. It fits to my policy. You do not have an exposure in that particular company. So why don't you pitch for that? And while you are pitching, I will give you a risk-based pricing so you can negotiate with that company till that level and you can enter into that. So this strategic role is now evolving as a CRO. So I think more or less in that way, while the CRO is placing a strategic role, also the CRO is placing a role of the navigator. Because rightly sir told there is a climate risk and all of things are happening which is really uncertain. So I always say this as a known unknown devil or unknown unknown devil. So these two things are very difficult to manage, to understand and to predict and navigate it. So the CRO's role will be more towards that in the days to come. Thank you.
No, I think Mr. Chaudhary very well articulated. You talked about a lot of use cases where data and analytics can now proliferate and help you in decision making. But Mr. Kumar, I will also want to ask you, all these saga that played out over the weekend, there are boomers and doomers, right? Sam Altman got fired, then got inducted, then got backfired. So a lot of things happen because there's one school of thought that believes that AI is here to change the world. Analytics is changing the world. And then there is another school of thought that says it needs to be used judiciously, right? There is a responsible AI, right? As a banking ecosystem, which part of the fence do we sit on?
Thanks, Abhinav. So the gentleman who spoke before me just brought out very clearly about the two factors. One is the risk, compliance, and the data, all the three. As far as the compliance is concerned, the money you spend on compliance will be less than when you don't comply with that. So that should be the underlying factor to make a decision about the data. So the first important factor to be noticed before getting into the subject of AI is the underlying data. And our Asutosh made a point about that CRO's role in data analytics and taking a decision thereof. The AI fit in there, whether it is going to do only the analytics part of it or it is going to be a part of the decisioning. That's a big jump and big the movement which is going to be there. So it's always said, the AI, no doubt it has come for good. Whether you like it or not, it has come for a stay. How we are going to use it is going to be the differentiator, and how we are going to make use of it in our day-to-day affairs as well as in our decision-making is going to be the differentiator. In this current form, if you ask me whether it is a panacea for all the problem, I don't think that it is going to solve all the problems in hand. And today in the banking industries, one of the major expectation is a regulatory compliance, transparency, and the customer supremacy. Will you be able to attain all the three with the AI is a mute question which we need to understand and articulate. I use it for a decision making, let us understand. Yes, we will go a little later how it is used for decision making. Is it transparent? Will I be able to showcase to the regulator or the customer the methodology and the decisioning details in AI? Big question mark. Because you are subject to scrutiny, you are subject to legal scrutiny, regulatory scrutiny, and the customer service scrutiny. In the AI-based decisioning, will you be in a position to bring out all the factors to convince the counterparty? Is a big thing which we have to keep in mind before getting to it. AI, no doubt, it has certain abilities. Some of the areas of the banking can be experimented with that. Many have done it also. Some have seen success. Some are in the process of learning the success. It depends on the data set below. If the data set which is below is correct, accurate, large, so it generates a pattern. It has an ability to understand the pattern clearly. If the pattern leads to the biased decision, see the whole important thing is that if I have a pattern of the data which is scrutinized, let us say that I've given only the data which is used for the sanctioning alone, the pattern and the bias will be different. And if it is used only for the rejection cases alone for decision making, pattern is going to be different. So the first challenge before the banking fraternity today is, yes, AI can be used in multiple phases, but do we have sufficient data, sufficient depth of the data, sufficient correctness of the data is a good question which you have to answer that. If you have all of them, yes, there are certain areas where use cases can be successful. In my view, the most important thing is the mundane work like the customer calling the call center, calling the branch, calling the manager, asking for what is my balance, what is the transaction number. Those kind of mundane work can be easily transmitted. I don't think the transaction level data mismatch will be there in the banking. The transaction level data mismatch may not be there. So that area, yes, it is going to help us. Customer service can be on terms of 24/7. You don't have a 3 shifts in the call center. The 1 shift is sufficient, the chatbot and virtual machines. But the question comes, today if I discuss with some of these AI propagators and the AI solution providers, they say that you can use it in terms of your decision making for the retail, risk underwriting, and you can use it for risk assessment, and you can use it for behavioral. There's always a comparison between how Amazon uses it for providing it. Amazon going to tell me that whether I buy a soap or I buy this particular fit out or that. Ultimately, it is me who is going to decide about it. Whereas in banking, the decision is going to impact not the buyer, it is going to be the seller who is going to be impacted. So whether there are models which have been time tested, the model of one unit, can it be adapted in another unit when I say the two different banks? It may not. Because the data set of that one unit need not be similarly placed for the data sets of another unit. And it cannot be for a longer period also. So in a way, it has an ability to read a large pool of data. So we need to have a large pool of data. It has an ability to understand the pattern and going to say that what sort of behavioral pattern is going to be there. There, the sidekick is that it should not be biased. The third important thing is going to give a prediction. The prediction can be positive, prediction can be negative, depending on what sort of earlier things have been addressed. If it is not a kundali where the people look at the prediction and then give you that. There, if something goes wrong, it is affecting me, whereas it is going to affect the balance sheet of the bank. So we have to be very, very conscious about the fact. Today, some of the use cases have been successfully tested and worked is that deploying them for enhancing the customer experience, right? The customer who walks in. Now, in today's world, we talk about hyper-personalization. Hyper-personalization is something which everybody would love to have. But in banking, to what extent you will be able to go to the hyper-personalization is a mute question again. At the max of what? You have around 10 products this side and 11 products that side. Combined together, it is about 10 into 11, 100 factorial way, 10 factorial ways of providing a product or providing. And on the fly, designing the structure for the retail product is yet to come into the system. Whereas you have some very structured product in the corporate side, as Ashutosh was telling it, how it will be able to do the structured wise, right now it is not there. Easiest way to deploy is a chatbot and virtual machines, where it will be able to understand the query, because the query, if you look at the pattern for the last 5 years, it is not going to be more than around 10 factorial ways of having the questions, which this has an ability to sort it out. One area where it can again help us to do is that the score-based lending. When my BRE engine is in a position to do the score-based engine, this can take you to the next higher level of understanding better than the BRE, able to predict whether this particular loan will be in a position to be collected in 30 DPD or 60 or 90 DPD, depending on the past pattern. So today it is too early day to decide that whether the AI is going to be a solution to all the problems with the banking fraternity is facing with. Can it substitute the compliance requirement? Can we be able to help us in complying with the regulatory? Yes, in a limited way we can do it. Even in HR, it can be of great use because HR is a pattern which you will be able to evolve. So today, many banks are saddled with attrition, right? The AI can help you to find out at the time of onboarding, right? This will be able to give us a pattern to see that whether this particular gentleman or a lady is going to stick with you for a period of 6 months or 12 months. That ability it has, because if you look at that, any bank which is having an attrition of 20 to 30%, whatever it is, it's a huge data is available over a period of the last 5 years. So these are the simple things which may not impact your balance sheet in a big way, can be the start for AI-related activities to be taken in the banks. Thank you.
It's a very profound way of looking at it, Mr. Kumar, that the underlying data sets is where the problem starts, right? And you did not say it, but the thing that was just running through my mind is garbage in, garbage out, right? If the things underlying are not useful, then pretty much the model will not give you the result. Madam, if I were to build on that thought, right, in my view, some of the early use cases in risk which were deployed on high frequency, high volume data sets were in retail lending portfolio, right? And over the last 12, 18 months, there is a view that there has been a lot of heating up in that portfolio. The disbursement rates have been higher than usual, and hence the delinquencies that we are also seeing are higher than usual, while the banking ecosystem as an overall is experiencing a decade low NPA, right? So would it be, like as Mr. Kumar said, that the data sets were not good enough and we just, tried to pull the trigger too soon and realized that we have got the models wrong? Or what do you think really explains the divergence on this portfolio?
Thanks, Abhinav, for that question. Just to set the tone, let me talk about, there is an old Chinese proverb, I don't know whether to call it a proverb or a blessing, which says, may you live in interesting times. I think we are all blessed We are all living in very interesting times. When you are talking about how this unsecured loan, retail loan is playing out versus the overall this thing. It's very interesting that the overall credit health of the credit portfolio is actually improving. The NPA percentages are coming down. Whereas if you look at it as segment-wise, the unsecured portion, the personal loans, the credit card and the other portion, the delinquencies are on the rise. But then if you look, this is the right statement if you look at the percentage-wise, what is happening. The data says in the last 2 years or so, the growth in the credit portfolio of the banks as a whole, the growth has been somewhere to the tune of around 13%. Whereas the growth on the personal loan side has been somewhere 23, 24%. And on the credit card side, they say it's around 27, 28%. So yes, in that sense, the growth in the unsecured segment is rising. And so also the delinquencies. But then the percentage is a percentage, right? A relation between two numbers. When the base is low, the percentage is bound to be higher either way, when it is growing or when it is reducing. When if the NPA is reducing and NPA is increasing and the growth is happening, that's because the base in itself is very low. The unsecured portfolio to the total credit portfolio is less than 10%, if I say. And within that, if you still make it into sub-segment, the personal loans are, of less than 50,000 is less than 2%. And if you then break it into less than 10%, it is 10,000 is even less. So in that sense, I would say like we shouldn't really compare and say that the unsecured loan portfolio is increasing so much. It's about the risk appetite. There is a trade-off. We need to, there are segments where there is more comfort, the risks are low, and then the return is also low, and that segment is a bigger segment that we have. And then there is always a portfolio, and then the riskiness of these unsecured loans. Let me go back to my days. You see, I'm almost a 4-decade old. I'm a 38-year plus years service banker. Those days in our banking time, when we did not have all these new concepts of risk and modeling and these things and all these technological advancements and the support that technology gives us, we used to be given 2 simple sentences before you give a loan. There are 2 things we needed to see. Will the borrower pay? Can the borrower pay? So when these 2 segments are taken care, I think the security part comes later. Security is only a backup in case he doesn't pay. So will the borrower pay is again today the technology is aiding me so very much. A lot of your customer behaviors are being mapped. The cash flows are being captured. There's many ways in which you can find out what's happening, and then there's a credit history to fall back. The account aggregator is a big game changer. You have the technology, you have the support system to even see, know, and lend. So in that sense, the unsecured loans portfolio in itself should not scare us that much. All the same, the percentage, what percentage of your lending should be in this unsecured portion vis-a-vis the total credit, there has to be a check on that, and that's how I would look at that.
Actually, when you started with the Chinese proverb, I really liked it because, the title is Winning in Uncertain Times. It could very well be winning in interesting times. It would have been a lot more optimistic way of putting it. So, Mr. Tiwari, if ever to come back to you, we have gone through the panel once and we have talked a lot about the volatility and while Madam reframed it to interesting, but yes, there is a spate of affairs which lends credibility to the fact that change is constant, right? Amidst this kind of a volatile world that we live in, how do we drive agility into risk as a function?
So first of all, I have to compliment Mr. Subramani Kumar on his mathematical skills. At 10 factorial, I think most people may not understand how to calculate. So maybe subsequently we can show that. And madam's living in interesting times is a synonym for living in uncertain and therefore riskier times in that sense. Having said that, the question is very apt because if you look at the basic definition of risk, it is the possibility of loss, which means it is not what has happened earlier, which is just a guiding principle perhaps It is how do we prevent, or first of all, recognize, measure all those definitions, and then finally prevent loss from happening. And therefore, if uncertainty is high, as it is in recent times, and I don't think that we are going to have a situation where it will be very predictable. So all the models which we have been using so far, including things like value at risk, have been shown in the crisis to actually aggravate the situation rather than help in terms of handling the situation. So therefore, agility in risk is extremely important. Now, how do we achieve this? Three, four things. One is, of course, the uncertainty about climate. We already discussed that. What do we do? Because climate change, and therefore the risk from the climate change is accelerating. It is not on a linear trend line. So as that rate accelerates, our assumptions of losses from that, and therefore the steps we are required to take, has to be also on an acceleration trajectory. So that is there. But also if you look at things like geopolitics, now generally our approach to geopolitics in banks, unless we have an office in that country, is that, well, we have a country limit for each country, and as long as we are within that limit, we are good. It's not as simple as that any longer. So we have to now look at the interplay between different countries, the trading which happens between, let's say, India and the rest. And since for India, the oil price is a very important metric in terms of fiscal deficit and all, in case there is an uncertainty in terms of war or any other situation like this, which can have an impact on oil price, then we have to model that way. And if that oil price goes up and Indian deficit goes up, inflation goes up, how does it play in terms of consumer demand and various other steps which we have to take? We don't have a control on that, but we must overlay these measures in terms of our macro view. And similarly, in terms of other risks, for example, the question about on the unsecured loans, which has been much in news these days, the simple thing is that each bank has to look at their risk appetite. Today, the risk appetite is very, very broad. And we have to be really focused on segmental risk appetite, product-wise perhaps ultimately, as to how much return we want overall within that vertical-wise, then product-wise, and therefore how much risk are we willing to take on a product, which is essentially the losses we are willing to take. And if we are willing to take a particular level of losses, then we should be able to open up that particular risk element. So just to give you a very broad example, self-employed segment is what most banks, in the public sector at least, are not very positive about for personal loans. Simply because this is a segment where the certainty of income is less, and therefore the risk of losses is higher. But there are ways in which there are other players who have been doing this very profitably. Because for us in the regular salaried personal loans, we hardly earn 10, 11%, whereas this segment of self-employed people are earning as high as 14, 15%. So if you have a 4, 5% loss also, you're still not earning a net interest margin of 10%. Now, if we have that kind of an approach, which today in the public sector banking space, at least that nuance is still developing. It's not there because too often we are totally wanting to be totally safe. There is nothing like totally safe in our banking space. In fact, our ability on the corporate side to take a risk is far higher than on the retail side. So in terms of agility, I think what the risk department needs to do is to continuously engage with the players in the segment. So in my risk department, I always tell all the teams, don't just sit here and look at models and create a report which is sent to the business unit that this is higher, that is higher. And don't only work through the limits which you have set for various exposure, etc. That's not the only way. That's just a very high level, 40,000 feet way. What is needed is for you to understand each industry. So please go and interact with the industry, go and see the unit, try to understand what are the drivers of that unit. So if you are talking about a steel industry, is the demand from China a major driver? Is the demand for raw materials a major driver? If those are, then what is the supply chain around it? And what are the risk factors around it? So before you look at the risk model for the business unit, you yourself have to understand. And in case you find that there is a sudden commodity down cycle, let's say as it is happening in a few segments now, can you see it 6 months earlier? And therefore, when the bank comes up with proposals for, let's say, commodity and mining industries, can we tighten that a little on the basis of that? You have to be forward-looking. You have to be able to predict in advance rather than reacting to something going wrong and then we tighten things up. That doesn't help at all. So this agility will come only by proactive engagement with industry, proactive engagement business unit, even proactive engineering with the other players in the industry. So when we dealt with diamonds, I told my team, please go and talk to IndusInd Bank. They are the best in the industry. So if they are able to tell you something which is there, that will help you also. And also talk to the few diamond players which are there. What is the impact of artificial diamonds in this space? All of this you have to model. You have to think about it and how can it impact, and then put that into the risk model. I think this is the way to go. And of course, the AI thing was talked about. Machine learning really can help us identify patterns and help us in projecting. The only thing is the projection will not be linear. It has to be an accelerated scenario, and we have to have those thresholds and different scenario analysis, which we have to think about, and what are the losses in those. So it's a very, very dynamic scenario. Currently, most of us are still working our way through it. Thank you.
Yes, Abhinav, just a point to add with what Mr. Ashwin said about. You just fix about the margin and assess the risk. And if the margin is there, the credit cost which we have assessed it is going to be absorbed and still it is going to leave. The people take a risk and then move forward. Absolutely fine, that's the way forward, the risk is assessed. Addition to that is that downturn. If at all another pandemic comes, we don't wish that the God will not be unkind to all of us to have another pandemic around. A situation which is stressful. So possibly you may have to have a stress testing with extreme or your unpredictable. If that is able to show some sense of sustainability and manageability, that also should be incorporated. So how it can be addressed is that your balance sheet cannot be concentrated. The concentrated is to be distributed across the product, across the segment, across the geography, across. See, that is also nowadays becoming one of the discussion point in our RMC and the rest of CRMC and whatever you call RMCB. So this is another factor which we have to incorporate in our entire risk appetite and as well as our risk consumption. So you can't say that the today is good. Of course, all of us are enjoying the good days of the post-pandemic, and we wish that continues like that, but the history has taught us that it's always not as peaceful as it is today. So that's also another challenge for the risk team.
I think both the points are very well made, what Mr. Kumar said, Mr. Tiwari said. Mr. Chaudhary, if I were to look at whatever we discussed in the first round and now what Mr. Tiwari and Kumar said, that there is an expectation that you need to engage more with the ecosystem. You need to be more well versed with the data, the analytics part of it, being able to ascertain trends from whatever is available to you as tools and technologies beneath it. What does it mean for the talent in the risk as a function, right? How should somebody joining the risk function today think about the next 5 to 10 years? How should you look at your skill set and toolkit?
Yeah, Avinav, now one round is over, and Mr. Tiwari also now addressed one part of it, of risk management. So while going through that, my thought process was a little bit changing, how the risk talent should see for next 5 to 10 years. Yes, whether we accept or we don't accept, couple of things will be there for a couple of years. Like your AI will be there, ML will be there, big data will be there, the computing technology or methodology will be there. Rightly, again, as said, there should be a stress testing, and all those things will definitely be there. But while all these things be there, what about the human intelligence? So I think the risk manager or the risk specialist is required to develop that acumenship of the human intelligence. Rightly pointed out, suppose a pandemic kind of situation comes into the picture. The catastrophic statistics is there, catastrophic stress testing is there. But with all such mechanism, can the organization run for a long period of time? Perhaps it is not. So what should be that particular thing which should be learned by the risk manager in the days to come is the resilience. Suppose a particular event happens without going for a number. If I can understand, is my organization resilient enough to sustain during this period and thereafter come up is more important aspect of the risk talent in the days to come. So while saying so, only understanding the statistics, the computing mechanism, all those jargons, does the subject knowledge, deep subject knowledge in a particular operation or business, the risk management talent has or not is also required to be seen. Suppose I had that particular nagging of a particular subject knowledge and I understand it better, then comes my communication skill, my inter-department relationship skills. Because gone are those days, I sit with my chair, I will analyze something, I will place to my management and they will take a decision. That will not be perhaps there because we are so interrelated and dependent. So this particular thing is also equally important for a risk talent in the days to come. Now, while discussing all this artificial intelligence and all those things, my sense now is that whatever may be the outcome, I think so, if I want to present to my management or board as a risk talent or specialist, I should have hands-on experience in Excel sheet. Because ultimately that will only give me a result and outcome which I can convince and present to my management and board. That's my thought process. Yeah. Thank you.
Please, please.
Just to add a point,
For a few years, but hopefully sometime we will see it through. Two questions. What would it imply for how do we use the data? Today there has been certain way that we've been using. Will it curb it? Will it further enable it? Where will it stand? And secondly, what kind of changes do you think we'll have to make in our tech stack to be able to actually conform with those kind of laws? And banking will be one of the ecosystems that will be impacted the most from some of these laws. Your thoughts?
absolutely, it's a very pertinent point which is just standing in front of every boardroom and as well as the CEO today. What is going to, how am I going to make use of this data? See, this has been last few years, if you start looking at it, there is a rampant analytic use of the data. The rampant use of the data with the permission or without the permission, let us park it. Now, here comes the big change. The DPDP just brought in the two perceptions. On the one hand, it has brought in, rightly so, the right of the person to protect or decide what he is supposed to, how his rights are protected about his data. We hear a lot of rumors about the other data has been taken out, credit card data has been taken out. Here comes the most important thing. Today, the knowledge of sharing my data with the outsiders is so limited. Possibly it is going to give them the first right, that you have a right, even if you inadvertently share it. The onus of protecting is on the recipient apart from what you are going to give. That's on the right side. The other side of that is that we need to necessarily process it in order to give a delivery of the service, a delivery of the outcome. And whether the lawfully how to handle it is what the second part. Probably the first part is the customer right of it, and second part is will have more impact on the bankers, especially the one who is using it. If you look at it, what are the common data? The mobile number has become, if you go to the Diwali, all of you would have purchased something on offline and online, both. First thing they ask, what is your mobile number? They'll ask you the name. Name, you can say anything because they're not going to verify. The mobile number, today, as a banker, we are using mobile as one of the authentication, scripting, one of the authentication of too many things. That's going to be impacted in a big way. The second, we make use of the mobile number so rampantly for not only for sending SMS, not apart from the marketing and other things. So the future holds for the bankers is that do we have the consent? The DPDP is just going to enforce a new concept called the consent of the person who is owning it. Today, I own my mobile number, I own my number, Aadhaar number, I own my date of birth, right? Can I make use of it for any purpose other than what it is intended, given, or it is a purpose-oriented? So we have to collect that consent. So probably the bankers may have to think of creating a consent database, which we don't have today. So that may be the moving forward, the consent. Then naturally it comes into the consent manager, consent. Then there will be a, who knows, there will be, now we have CDO, no? Chief Digital Officer. There will be a Chief Customer Consent Holding Manager. I mean, you will create. We are all good at creating acronyms and creating a position. But the responsibility is going to be humongous. For the simple reason, it is not necessary for him or the person who is sharing the data to prove a point it has been misused. It is for the person who is using the data to prove a point that, yes, I used it with his consent or without his consent. So it's good. And another important thing is throws it. If he has given it for a limited purpose, the DPDP says that you are not supposed to use it beyond the timeline what he has given. He opens an account with me. He opens it with the KYC, know your customer regulatory prescription. He says for opening my account only. Can I use the KYC for giving my card? Can I use the KYC for giving him another subscription? No, I need to have an explicit consent. Although some banks have an opening form where everything is put tick, 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 tick. The tomorrow you'll say the tick has been done without my explicit consent. That's going to be a challenge. So the challenge before us is that it is not sufficient you have a consent. You must have an evidence to prove that it has been given with his wholehearted consent. So this is going to be the big challenge for the bankers in DPDP. And of course, today we are talking about hyper-personalization. I don't know how the hyper, tomorrow I can just write a letter to the Amazon and say that, who asked you to suggest me this particular product? That means you have seen my behavioral pattern, you have seen my pattern of using. Do you have a right? So this may, I'm just extending to the extreme case. I'm asking to pay me a penalty of having used my behavioral study without my consent, give me 1,000. Some, like a consumer court, there may be a concerned consumer court will pop up which will say that to give 10,000 rupees as a penalty. So it's a very challenging days ahead. And even you have a GDM, I mean, like you have the General Data Protection Act in EU. Like it's still there. It's always contested. You know, some of the big, I mean, like the likes of Google and likes of Amazon, they're just struggling to stand before the scrutiny of that. So it's a big challenge for the bankers. Do you have a solution or answer to it? No. But it is the right time that we have started moving in the direction of collecting the consent and then started mapping it with the purpose for which the consent has been taken. And of course, one big advantage of the bankers is a distributed setup. You have a better relation with the customer. You'll be able to sit along and then try to explain to him and then start collecting the consent and timeline also. So you have to make a small beginning. The consent database is one which came to my mind when you asked about it. So it's a time that you don't have a database of a data alone. You need to have a consent forms also to be collected. That may be the way, but it is a very long way to go. The second part, as far as the second question of yours, whichever system is going to affect, I can say whichever system not going to affect. That will be much easier and simple line. The only system which will not be much affected is the HR system, because the guy is working with you. He may not try to dispute you till he is going to resign or he is going to quit. All of the systems are touched. All of the systems are going to be used in a big way. This is going to be a challenge for us.
Thank you, Mr. Kumar. Ma'am, I will want to end this round with a bit of a more philosophical question. You know, I'm a mechanical engineer, and you know, in my courses, teachers used to tell me, when in doubt, make it stout, right? So if you're in doubt, you can obviously, you know, you can have stronger guardrails around risk and compliance, right? But we also have a business to run, right? And the results to report. How do you draw the balance between the guardrails and the balance sheet and the profitability?
So, good you raised your mechanical engineering background in the questions. So let me also come back with another situation which can draw a parallel to what you say. Generally, when we used to hear stories, they used to tell that the fire, you know, they say either the fire should it be your master or your servant. So if it becomes a master, it engulfs you. And if it's a servant, that's the best servant you can have. So also the risk, the compliance. While our motto or our goal is to maximize profit. Okay, public sector banks, we can't really say that that is our number one goal, but still, profit is one of our main targets. Whether risk and compliance is going to be an enabler there or a dragger there is the main question that you are asking. How do I maximize or how do I increase my profits? One, to grow my business. By growing my business, Two, by pricing it right, right? To grow the business, only my risk and compliance will tell me where to grow, where not to grow, where to be careful, where I can go faster. How do I price, whether I'm pricing it right? Because if I don't price it right, either I lose business or I will end up driving my customers away. Again, there is a risk and compliance which tells me what is the price that the load that the thing can, traffic can take. So in whichever way you want to look at it, I will say that they are complementary. Risk and compliance go with my profit. I won't say that risk is going to pull me down, especially in these uncertain times. When if I let go of my risk and compliance, there is every chance that it may look like I'm pursuing a more profitable avenue, but in the long run. So when it's a marathon that I'm running, the risk and compliance is going to show me the road so that I know where I'm riding, how is the travel going to be. Thank you.
Thank you very much, ma'am. I think when you were explaining, one another analogy that came to my mind is that it's typically the brakes that make you go faster, right? Because you have confidence that you can stop in uncertain times. So thank you so much for that perspective. I think we still have a couple of minutes. Any audience questions before we close for the day? I see a couple of hands. Is there a possibility to get a mic?
Thank you. Thank you. Good afternoon, sir. Ashutosh sir made very interesting comment about the CRO role being a navigator during uncertain times. And of course, he plays a strategic role during and helping us win. My question is around AI. Are we just going to cast away AI because it's not explainable and it's not accurate? Or are we going to see it as more a co-pilot which helps summarizing us key details, giving us interesting patterns? That's my question.
Well, it's a good question. You have to decide whether you wanted to use it AI as a substitution or a supplement. The moment it is a supplementing your efforts in risk assessment and compliance, it is going to co-work with you and travel along with you. The moment you wanted to substitute, probably that you have to take a deeper dive into the data, deeper dive into whether the data is a biased data, or the data is a generic in nature, will it be able to stand the test of the time? If your data is so accurate, the predictions are going to be near accurate. If the data is having its own misses and matches, because I have been working in the industry for around 45 years, I have never seen a data, anybody, even the best of the data governance team is not able to give me a satisfactory response saying that, yes, sir, this is one small miss. So with that kind of miss, my suggestion as an individual will be that it can be a supplement to your efforts. To start with, the AI is a good substitute for where it is in a position to replace the mundane work. Like the guys are walking in, asking about the product, asking about the best of the advisors. The same person is asking you to do the credit decisioning through that. But it is going to supplement in your assessment and then give you the outcome-based output, which you are going to assess it as an outcome. AI is the best. And it can be used for, centralized operations if you have. Trade app, Forex, or whatever it is, the AI will be in a position to step up the automation and bring in the efficiency which we are all craving for. It can substitute and sit into your call center and make that call center into a contact center, which we are missing, many of us. And taking that contact center to contextual center, AI is the best fit. Because the contextual center is not going to predict something which people are going to. It is going to understand the behavior pattern of the person and going to say that, yes. So if upgrading from call to contact to contextual, AI is the best fit. And it can be used in a customer experience. See, it is not like an e-commerce experience, what you can offer it in the banking. It's always an experience depending on, because the boundaries in which the bank is going to operate is extremely regulated. So it is easy to give over the customer experience enhancement, which today, I do not know. Suppose a customer has called up with one particular problem, maybe a month or a quarter or a half year before. He comes back with the same problem, let us say after 6 years. Today, the current setup, I don't think that we will be in a position to address it. But the AI will be able to quickly respond back and say that, yes, sorry, Mr. ABC, we're extremely sorry. Last month also you had a similar episode, and this is what it is. See, this is going to douse I'm not telling you to douse the complaint, but it will reduce the intensity of that the situation. So these are the situations you have to do a lot of deep dive within the bank to see that where it will fit in, where it will not fit in. So my view is that where it is going to hit the balance sheet, hit the P&L, you have to be a little cautious about it. Where it is going to enhance the experience, where it is going to enhance the experience for the customer, experience for the people who are operating the system, that's the best fit. Hope I addressed your point. Thanks.
We are just in time to hand over the stage for the next session. Before I end, would just love to thank everyone on the panel for such candid thoughts and everyone patiently hearing us out. And my takeaway would be, we could very well say winning in interesting times. And thank you so much for changing the motto and making it more optimistic. But really appreciate everyone being here and thank you so much.
Thank you all dignitaries. I am sure this session has answered our queries on how should bank navigate these uncertain times. Thank you all dignitaries. Dear all, please be here for 5 minutes to change the dais for next session. May I request everyone to please be seated.